Marcus is 31 years old. He makes $78,000 a year. He's been quietly disciplined for 6 years. Brown bag lunches, no car payment, roommates longer than he wanted. And 3 weeks ago, he opened his banking app in the parking lot of a Walgreens and saw for the first time in his life a number that started with a 1 and had 5 zeros after it. $100,247. He sat in that car for 11 minutes. He didn't celebrate. He didn't call anyone. He just stared at it, refreshed the page once to make sure it was real, and then felt something he wasn't expecting. Paralysis, because now he has to do something with it, and everyone around him has an opinion. His coworker says crypto. His dad says real estate because that's what worked for his dad's dad. Some finance influencer on YouTube, probably this one, says index funds. And somewhere in the back of his mind, a voice is saying, "You've been so careful for so long, maybe you've earned the right to breathe a little." That last voice is the most dangerous one. And I'm going to explain exactly why and exactly what Marcus should do instead. Because the decisions made in the first 90 days after hitting $100,000 will determine whether that number becomes $2 million or just stays a number. My name is Nick, and we're going to do this properly. Here's the first thing you need to understand about $100,000. It is not just a psychological milestone. The math of this number is genuinely structurally different from every dollar you saved before it. Charlie Munger, Warren Buffett's business partner and one of the greatest investors of the 20th century, was once asked at a Berkshire Hathaway shareholder meeting how regular people could build real wealth. And after Buffett made a joke, Munger leaned into the microphone and said something that personal finance people have been quoting ever since. He said, "The first $100,000 is a bitch, but you gotta do it. I don't care what you have to do. Like, if it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit." Now, most people hear that quote and focus on the first sentence, the grinding, the sacrifice, the suffering, but the important part is what he said after. After that, you can ease off the gas. Why? What changes at $100,000 that doesn't exist at $80,000 or $50,000 or $30,000? Here's what changes. Your money gets a job. Think about that for a second. At $100,000 invested at 8% annual returns, your portfolio generates $8,000 a year passively without you clocking in, without you grinding, without you bringing lunch from home. That's $667 a month appearing in your account because the money you already earned is now out there earning on your behalf. It has its own salary. It shows up to work whether you do or not. It doesn't call in sick. It doesn't ask for a raise. It doesn't have opinions about crypto. And here's where it gets genuinely wild. Let's say Marcus is saving $1,000 a month on top of that $100,000. At 8% returns, his first $100,000 took him about 6.4 years of grinding to accumulate. His second $100,000, that takes 4.2 years. His third takes 3.2 years. By the time he's building his fifth $100,000, it arrives in roughly 2 years, without him saving a single dollar more or finding a single better investment. Same savings rate, same returns, just the compounding machine doing what compounding machines do when you finally give them enough fuel to run. The math doesn't just improve after $100,000, it accelerates. Every subsequent milestone arrives faster than the last, like a boulder that's finally crested the hill and is now rolling on its own. And the only way to stop it is to make one of 3 specific mistakes, which is exactly what most people do. I want you to understand something before we get into this. None of these mistakes look like mistakes while you're making them. They all feel responsible. They all feel safe. That's what makes them dangerous. And the first mistake is the one that looks the most like wisdom. Marcus has $100,000. He's been burned by uncertainty before. He watched people lose money in 2020. He's heard the horror stories, and frankly, he worked really hard for this money, and he cannot stomach the idea of watching it disappear. So he puts it in a savings account, a regular savings account at his bank. And every month he watches the balance sit there safe and protected, earning roughly $30 in interest. What Marcus doesn't realize is that he's not protecting his money. He's slowly feeding it to inflation. The national average interest rate on a standard savings account usually hovers near zero, often under 0.5%. Meanwhile, historical average inflation runs closer to 3%. Every single year Marcus leaves his $100,000 in that account, he loses purchasing power. $2,000 to $3,000 a year in real value, gone. Not dramatically, not visibly, just quietly evaporating while the balance on the screen stays the same. Over 10 years, Marcus has lost substantial purchasing power while earning almost nothing. Meanwhile, $100,000 invested in a simple S&P 500 index fund at historical average returns would have become approximately $260,000 over that same decade. He doesn't get the $260,000. He gets his $100,000 back. Slightly worse, the account looked safe. The account was a slow bleed. The second mistake is the one that feels like ambition. Marcus has real money now. He starts paying more attention to finance content, which means he starts hearing about things. Crypto cycles, AI plays. A real estate syndication someone at work put $30,000 into. He downloads a brokerage app, and suddenly he's researching individual stocks at midnight, convinced that with enough research, he can identify something the market hasn't priced in yet. Here's the data on this, and it is not gentle. Dalbar, a financial research firm, has been tracking how average investors actually perform versus the market for decades. In 2024, the average equity investor earned 16.5%, while the S&P 500 returned 25%. That's an 8.5 percentage point gap in a single year. Not because people picked fraudulent companies, because they bought high, sold when it dropped, chased returns, timed things wrong, and let emotion override math. Over 30 years, that kind of behavioral underperformance on a $100,000 starting point cost you over $860,000, not because the market failed you, because you got in your own way. And if you think professional fund managers do better, they don't. The Spiva scorecard found that 65% of active large cap fund managers underperformed the S&P 500 in 2024. Over 15 years, the failure rate exceeds 90%. These are people with Bloomberg terminals, research teams, and MBAs from schools that would laugh at your application. 9 out of 10 of them can't beat the index. The solution isn't to try harder than they do. It's to stop competing with the market and just own the market. The third mistake is the quietest one, and it's the one Marcus is most at risk of making. He's been disciplined for 6 years, brown bag lunches, no car payment, saying no to things his friends said yes to, and now he has $100,000 and some part of his brain, a very reasonable, very human part, decides he's earned a little loosening. So he upgrades the apartment, nothing crazy. Just a nicer place, like slightly better restaurants, stops tracking as carefully because, hey, he has $100,000. He must be doing something right. Psychologists call this the arrival fallacy. Harvard researcher Dr. Tal Ben-Shahar defines it as the illusion that once you reach a goal, you'll experience lasting happiness or satisfaction. What actually happens is the satisfaction fades within weeks, your new baseline resets upward, and the discipline that built the $100,000 quietly dissolves. Because your brain has decided the destination was reached, Parkinson's law, applied to money, predicts exactly what happens next. Expenses expand to fill the income available. The $100,000 stops growing. The momentum breaks. And 5 years later, Marcus is a 36-year-old with $130,000, having spent 6 years generating $30,000 of growth on an account that should have tripled. He didn't blow the money. He just stopped treating it like a starting line and started treating it like a finish line. That's all it takes. Here's where we shift gears entirely, because everything I've described so far is what not to do. And now we're going to build the exact framework that turns $100,000 into a genuine wealth building machine. The order of operations here is not arbitrary. Get it wrong, and you leave tens of thousands of dollars on the table. Get it right, and the whole thing compounds in your favor for decades. First, lock in the foundation. Before Marcus invests a single dollar of that $100,000, he needs 3 to 6 months of living expenses sitting somewhere liquid, accessible, and actually earning something. For an average household spending around $6,500 a month, that's $20,000 to $40,000, not in a standard savings account earning 0.39%, in a high-yield savings account paying 4.0 to 4.2% APY, which is what the best accounts are offering right now. Before Marcus invests a single dollar of that $100,000, he needs 3 to 6 months of living expenses sitting somewhere liquid, accessible, and actually earning something. For an average household spending around $6,500 a month, that's $20,000 to $40,000, not in a standard savings account earning pennies in a high-yield savings account. These accounts pay a competitive market rate, historically 10 to 12 times higher than traditional banks, just for keeping your money there. Second, capture every dollar of your employer change. And if Marcus's employer offers a 401k match, this is the single highest return move available to him in the known financial universe. A 50% match on contributions is a guaranteed 50% return before the money has touched a single investment. A 100% match is a guaranteed 100% return on day one. There is no stock, no index fund, no real estate deal, no crypto play that offers a guaranteed double before anything else happens. If Marcus is not contributing enough to capture his full employer match, he is handing back part of his compensation. The company offered it, he earned it. All he has to do is take it. Third, settle the debt question with math, not emotion. Here's the clean framework. If a debt carries an interest rate above 6 to 8%, pay it off before investing further. If it's below 5%, invest instead. The gray zone in between comes down to risk tolerance. Why 6 to 8%? Because the long-term average return of a diversified stock market portfolio is historically 7 to 10% annually. Paying off a debt at 20% interest, a credit card, is a guaranteed 20% return. Nothing reliable beats that. But a mortgage at 4%? Mathematically, Marcus is better off investing because the expected market return will likely exceed what the debt is costing him. The critical word is guaranteed. Debt payoff delivers a guaranteed return equal to the interest rate. The market delivers a historically higher return with real volatility. Know which one you can stomach. Fourth, and this is where most people leave the most money on the table, 3 accounts. All of them underused, all of them legal, all of them dramatically better than paying the IRS more than you have to. The Roth IRA first. The contribution limit hovers around $7,000 to $7,500 per year, depending on inflation adjustments. The money goes in after taxes, grows completely tax-free, and comes out in retirement completely tax-free. Not deferred, free. You pay taxes once, and the IRS never touches it again. Not on the growth, not on the withdrawals. If Marcus maxes his Roth IRA consistently from age 31 at 8% returns, he retires with roughly $1.9 million that the government has zero claim on. That's not a tax advantage. That's a different category entirely. If Marcus earns above the Roth IRA income limits, which usually phase out for single filers roughly between $146,000 and $161,000, there's a legal workaround called the backdoor Roth. They contribute to a traditional IRA on a non-deductible basis, then immediately convert it. A couple of extra steps, one additional tax form, and the outcome is identical. Worth knowing. Now, the HSA Health Savings Account. This is the most underrated financial tool in the entire tax code, and I'm going to need you to actually pay attention here because most people glaze over at the letters H, S, and A and move on with their lives. That is a mistake. The HSA is the only account in existence with a triple tax advantage. Contributions are tax deductible. They reduce your taxable income dollar for dollar. The investment growth is completely tax-free, and withdrawals for qualified medical expenses are tax-free at any age. After 65, it functions exactly like a traditional IRA for non-medical expenses. You just pay ordinary income tax, no penalty, there are no required minimum distributions, it never expires, it rolls over every year forever. The optimal play. If Marcus can afford to pay his medical expenses out of pocket now, he should. Pay the doctor bill from his checking account. Keep the receipt. Let the HSA balance compound untouched in index funds for 3 decades. Then, at 65, reimburse himself for every receipt he kept. There is no time limit on reimbursement. He's essentially been running a secret retirement account that happens to also cover his healthcare costs. The IRS is completely fine with this. Marcus probably should have started doing it years ago. The annual contribution limits sit roughly around $4,300 for individuals and over $8,500 for families, subject to annual inflation adjustments. Then max the 401k beyond the match. Now, the employee contribution limit is currently over $23,000. Combined with employer contributions, the total can reach nearly $70,000 per year going into tax-advantaged growth. That is a staggering amount of capital accumulating outside of the IRS's annual reach. Fifth, everything remaining goes into a taxable brokerage. And here's the only part where simplicity isn't boring, it's actually the answer. 3 funds. That's the whole strategy. A total US stock market index fund like VTI, a total international stock market fund like VXUS, a bond fund like BND. These 3 funds collectively hold roughly 22,000 individual securities across dozens of countries, and the total annual cost to own them is about 0.04%. That is $40 per year on a $100,000 investment. The average actively managed fund charges 10 times that for the privilege of underperforming the market 90% of the time over 15 years. That's not an exaggeration. It's the SPIVA data. Professional investors with every resource imaginable failing to beat a fund that just quietly owns everything and charges you $40 a year to do it. Stop trying to be clever. Own the market. Let it do what it has done for a century. At $100,000 in savings, real estate isn't off the table. But the way most people approach it at this milestone is backwards. They think about buying a single family home as an investment and holding it. That's fine if the numbers work, but with median home prices north of $400,000 in most markets and interest rates remaining volatile, the math is tight and the competition is brutal. The move that actually changes the math and that almost nobody talks about is house hacking. Here's how it works. Like Marcus buys a duplex, he lives in one unit and rents out the other. FHA loans require as little as 3.5% down on multi-unit properties up to 4 units, as long as you occupy one of them. On a $400,000 duplex, that's $14,000 down. If the other unit rents for $1,800 to $2,200 a month against a total mortgage and expenses of $3,000 to $3,200, Marcus's effective monthly housing cost drops to somewhere between $1,000 and $1,400. He is building equity. His tenant is paying the majority of his mortgage, and he still has the bulk of his $100,000 deployed in his investment accounts. It is not glamorous. His neighbor is technically his tenant, and that has its own textures, but the wealth building math is genuinely difficult to argue with. If Marcus doesn't want to be a landlord, REITs give him liquid real estate exposure with none of the property management headaches. VNQ, Vanguard's real estate ETF, holds 158 real estate assets, pays a dividend yield around 3.8%, and costs 0.13% per year to own. Not the same as owning property, but participation in real estate returns with complete liquidity and 02 AM phone calls about a broken boiler. Here's what I want to leave Marcus and you with, because it's the part that changes behavior rather than just adding information. 6 years ago, Marcus was the person grinding to get to $100,000. Every dollar felt manual. Every decision felt like sacrifice, and he was doing the work, and the money was mostly just tracking his efforts, one hard-earned dollar at a time. That era is over. At $100,000 properly invested, Marcus's money is now generating $8,000 a year on its own. By the time it reaches $500,000, that same portfolio, at 8% return, will be producing $40,000 a year in passive growth, more than half of what he currently earns at his job. By $1 million, it produces his entire salary every year without him doing anything but leaving it alone. The people who build real wealth after $100,000 aren't the ones who find smarter investments. They're the ones who stay relentlessly boring, automating contributions, ignoring market noise, routing half of every raise directly into investments before it can become spending, and never confusing a starting line for a finish line. They protect the psychological ground they've won. They understand that the second $100,000 arrives 35% faster than the first, and that the third arrives faster than that, but only if you stay in the game. Marcus doesn't need to be smarter from here. He doesn't need a better strategy or a hotter stock or a real estate deal. That sounds too good to be true. He just needs to set up the accounts, automate the contributions, and then do the hardest thing in personal finance. Get out of the way and let the math run. Because here's what Munger actually meant when he said, you can ease off the gas after $100,000. He didn't mean stop. He didn't mean relax. He meant the grinding, scraping, sacrifice everything phase is behind you now. And ahead of you is something different, something quieter. The part where your money stops being a number you watch and starts being a force that works while you sleep. Marcus has been waiting 6 years for that. The parking lot moment wasn't the end of something. It was the beginning of everything that matters.